football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Time once again for another edition of Red Zone Retirement Program, Simple Investing, Smart Future with John Mears and myself. And John, we're going to talk about kind of your, I guess, maybe close out year-end meeting conversations, some of your strategic and tactical meetings that you have with clients. And we're going to have some graphics to go up this week to kind of illustrate some of that. So we'll dive into it. But how are you, my friend?
Doing great because I'm in the middle of this. I am super busy, but this is also a fun time of year for me. When I do these, a lot of advisors will call that a fall review. I tend to be a little bit more deliberate in what I'm calling it because it is a strategic and tactical meeting we're doing every October with our large clients. And when I call it a strategic and tactical, that means the strategy. We have to make sure we're all aligned on our strategy. Yeah. And then the tactical, that's how we get there. So we may say, hey, a Roth conversion is important, but how are we going to do it? What is the right way to approach that? And so we do this again, we do it intentionally and deliberately every October. We go through this with our large clients. I have a lot of fun doing it, but yeah, I'm pretty busy and I'm a little sleepy right now. So yeah, it's all good.
I hear you there. Well, we'll pop some of this stuff up on the screen as you're talking through some of it. And then that way people can kind of see what we're talking about, and we'll have the editor kind of try to focus into different places when you're doing it. Cause I'm sure some of this stuff might get a little small on the screen, depending on what you're watching this on. Like if you're on your phone, it might get a little small, but we'll try to enhance this and move this around. So where do you want to start?
So we'll start off with the very first thing when I meet with people, I go over 4 different reports. And the very first report I do is a tax and Roth conversion report. And basically what we do is we take last year's information that we have from your tax return. We kind of implement that and kind of take a look at, okay, should we or should we not do a Roth conversion? If we do, what would that amount be? And we actually do this mathematically. Now there's other work that's going on behind the scenes. So I'm trying to give the client a 1-page visual here of what is going on and what they should be doing rather than giving them 18 pages of all the data. So I try to give them a high level, okay, should we do the Roth conversion? Yes or no? Yes. Okay. How much? And again, we have this all calculated out. And then I also try and figure out, okay, how does this affect perhaps your Medicare, your perhaps hidden IRMA charges? We want to make sure that we don't do a Roth conversion that might trigger that. Or if we do, we have a reason for it. Hey, what is that amount going to be? Is it going to go from 180 to 259, 185 to 259? Is it going to do that $70 higher? Yeah. If so, let's know that ahead of time rather than a surprise 2 years from now. So we want to know what is going on with that as well. So we kind of do a high level idea here of whether or not philosophically we want to do a Roth conversion. Sometimes the answer is no. Yeah. But if we do, we want to know what that number might be.
Well, and John, you mentioned as people are listening, you kind of quickly said 2 years from now. If you did not check out our conversation we had on IRMA a little while back, just to remind folks that the IRMA surcharge is a backward looking penalty.
Yes.
Yeah.
Yeah. So that makes it even more interesting when you get that love letter from Medicare 2 years later, because you probably have forgotten about all this by then.
Yeah, this is episode 96. It was actually back in 94, just earlier in September. So if you want to go check that out, certainly, on YouTube here, go check that out to kind of learn a little bit more about the IRMA, but just to kind of give people a point of perspective there. So anyway, go ahead.
Yes. So we will want to make sure we take care of this ahead of time, and that the devil is better than the devil you don't know in that case.
For sure.
We also want to make sure that clients know if we're going to do a Roth conversion, what is that dollar amount going to be? So if you're in the 12% bracket and you're doing a $20,000 Roth conversion, the math is pretty simple. 20,000 times 12, that would be $2,400. There is a little bit more nuance to that. And if there is, I will talk to the client about that because there are other things that may affect what your actual tax may be. But this gives, again, we're looking at high level here. Again, the strategy is whether or not we're going to do a Roth conversion. And again, the tactics are how are we going to go about doing that?
John, so when you're doing conversions, are you filling up brackets that way? I think people get confused on that. Can you do that as well?
Yeah, so ideally we were trying to fill up whatever bracket you're in. Now there are currently reasons to go beyond that, but if you're in the 12% bracket and you have some room, so let's just say $95,000 is where the 12% becomes the 22, for example. And I'm roughing out the numbers here right now.
Sure.
But if your taxable income was $75,000, and the bracket goes up to 95, that gives us $20,000 to work with here. Okay. So we want to try and fill that up before we kick in a higher tax bracket, because the idea behind the Roth conversions, and again, we're not going to get too deep in the weeds here, but it is to pay tax, control whatever tax rate we're paying at.
Gotcha.
So if we're in the 12%, we want to pay tax at that before we're going to be perhaps in the future in the 22, 24 or higher tax bracket. So we intentionally do that. Now, there may be reasons. And I just talked to a client the other day about, hey, you have saved so much. You're a super saver. You've done a great job that your RMD in the future will push you into at least the 24, perhaps the 32% tax bracket on using today's tax brackets. So you may want to go beyond your current tax bracket, which is only 12%, and go up to the 22% bracket. And so right now we're contemplating that. We're actually I kind of explained that to him, and now he's working on that, kind of, going through that in his head, whether he wants to go ahead and pursue that, going to the 22% bracket.
Yeah, so you're getting proactively managing this ahead of what could be a bigger bill down the way.
Correct.
Yeah.
So Roth conversions are all about tax arbitrage. That's all it is. We're trying to pay tax at a lower rate rather than a higher rate. And that difference is whatever we, the advisors and tax preparers, are saving our clients. So if you have $1 million and I can save you 12 to the 22% bracket, that's 10%. I can save you quite literally $100,000 if we do this correctly. So
nice.
That's nice. Adult money. Maybe some of you out there don't care about $100,000, but I would. So
well, if you don't click the links below, let me know. I'll be happy to take that off your hands. No, I'm kidding. All right. So what else have we got on this first sheet? Or let me know when we need to go. Now, I'm assuming that Mr. Trout came in and
yes. So this is Mike Trout was in in this example, he was in the 35% bracket. So we probably wouldn't be doing a Roth conversion at that. So again, I'm just kind of showing this for fun.
I know, yeah.
But again, the pictures here are is the exact report that I give the clients, and this is something for them to review. I give this to clients ahead of time too. I send out a package since we're 95% virtual right now. I send the package out to the clients ahead of time, so they've actually had a chance to look at this before our Zoom meeting, and then we're going over it in detail face to face when we're talking over Zoom. So this is a picture of what the report looks like, and as you can see, it's a visual, and that will probably segue to the next report I go over with clients is their income strategy using Guardrails, because that is what people are interested in. Is okay, we talked about our tax strategy. Now, what about our distribution strategy? And what we go over with our Guardrails, and we've talked about that in prior episodes as well. So we're not going to go too deep here.
I like this though. You got the good times guardrail and the bad times guardrail. I like
yes, that. Exactly.
Yeah.
So we show that there's an ebb and flow with the markets, that your account can be going up and down, and that's okay. There's a range that we're comfortable with. However, if we go below that range, we might have to make some adjustments. Now, when I tell people what the adjustments could be, it's usually not that severe. In the example we have here with this couple, they're able to take out a $4,000 a month distribution. But if the markets decrease from 900,000 down to 750, they have to basically tighten their belt a little bit. Instead of 4,000 a month, it's 3,600 a month. And when I tell people this, they really kind of look at me and go, really, is that all I got to do? Yeah, you don't need to go all cash. You don't need to redo your portfolio. You don't need to change a whole lot. You need to tighten your belt temporarily until the markets start to behave again.
Yeah, $800, not the worst.
It's not fun. I'm not going to say it's okay, but it's a lot better than the stress you have to go over. And what I tell people all the time is, it's right here. It's written. It's in black and white. So you can see what the target is. So if the markets are misbehaving, you can actually refer to this sheet and go, okay, we're from 900 down to 850. Now that stinks. We don't like that, but it's still okay. If we go all the way down to 800, it's still not good, but again, we're still okay. Once we get down to that 750 range, then we have to start considering whether or not we're going to make our adjustments to our monthly distributions.
Gotcha.
I think that's great news for people to hear that, so they can kind of, again, see what exactly the expectations are, because we have a written plan, a strategy for what we will do if the markets decrease. I have so many people that come in that say, hey, I will ask them, what is your strategy, or what was your prior advisor's strategy when the markets decrease? And they always say, wait it out. Folks, wait it out is not a strategy. And further, I'll submit to you that waiting out could actually harm your future possibility of surviving without running out of money.
Okay.
So you will have to do something at some point, possibly. So this is why we have this written down. Now, in the pandemic, the markets decreased. I had to send out warning emails to people, but it never actually triggered, because as you guys remember from the pandemic, it kind of bounced right back
pretty
up.
Quick. Yeah.
But we were on top of it. We were alerting the clients who were receiving distributions, and we kind of said, hey, by the way, we're there, and we were being proactive about it. So the client wasn't panicking. I had very few clients that were super, super panicky during the pandemic. Went down 30% in 3 weeks, folks. So that was pretty quick. But this is, again, this sheet here, which we provide to you every October, gives you the blueprint about what to expect in the future.
Okay. All right. And so that's very, very helpful. So hopefully folks can see that well and kind of highlight some of these things. Where are we going next?
The next report they go over is the asset map report. And this is just a quick snapshot, again, a visual. Okay, folks, there's a theme here. I like to give visuals, and this may be small, but if you're able to see this, it kind of has a picture of the husband and wife. On one side, it has the husband's income. The other side has the wife's income sources. And then we also have what the husband owns separately and the wife owns separately, perhaps IRAs for most people.
Okay.
And then in the middle, we have all their joint assets. We kind of show the home, any joint accounts they may have. We have their life insurance on there as well. So it's a quick, easy visual to see kind of your whole financial life on one page. So I love awesome. The asset maps. People will come in and say, oh, by the way, I forgot you need to add this thing to this. And so it helps me do a better job as a planner to kind of see visually all that you have as well. So it's a great net worth statement, but it's visual. My clients love it. This is one of those things that it's almost like Freebird. They want to hear that at the concert. Well, this is what they want to see when we meet. They love
Freebird.
This asset map.
Freebird.
Yes.
Yeah.
So if you're watching this video, go ahead and get your lighter up.
Get the lighter out. Yeah, exactly.
A very popular report that I go over with people. So.
Well, this is great because it does let you kind of see how everything's laid out. It's really very simple, and you kind of know what's your assets, what your income
what you have.
Looks like. Yeah, what do you have?
Yes.
Okay, very cool.
And then the last report I go over with people is just a simple performance report. So I go over that with people, and we kind of the thing I like to show is this mountain chart on here. We can kind of get into the weeds about whatever exact performance is, whether it's 6.8%, 8.3%, and all that. Most people, I have this one woman I'm thinking of right now as I'm speaking, all she ever asks is, John, am I up? It's like, yes, you are. And this mountain chart is a really good one to show here on the right-hand side. If you can see this on your screen, the light blue line shows what the net is, what a person has put in. Maybe if they're taking distributions, the line could start decreasing, but it shows the net in. And then the gray mountain chart shows what the balances of your account. So it's a great tool to kind of see, okay, am I ahead? Yes, you can see in 2022, this particular person, they were down during the bond crisis. And then back in the pandemic, we saw the same thing where we were down temporarily, we recovered. And this is a great visual to show how you've been doing over the last several years and how your account's doing. Rather than, again, people, when I tell people a percentage of what their account's getting, it's just, I might as well be speaking another language. They don't understand this. People understand visuals, and that's why I show them these visuals. Same with that pie chart right next to it shows how we're diversified in so many different ways, which we all know diversification is the secret to success. Well, again, you see that here visually. So I really like this performance report, kind of lets people see, and there are other pages which we won't get into right now, but this is a great visual for people to see how their account's doing. And then there's other nerd stuff behind that, which we'll go over with the clients as well. But those are the 4 reports I go over this time of year. Now, naturally, if a client has something that's top of mind with them right now, where should they sell a rental? Or things like that. They may be looking at changing their beneficiaries. We'll always go over whatever's top of mind of the client, and we'll never skip that. But again, I meet with people every October. The reason why I do it in October, not November, December, that gives us some breathing room. If we need to contemplate anything, if we ever need to get any paperwork in, it gives us ample opportunity. I don't do it before then because we just don't have enough information before then. So October is kind of that ideal time to have all this information. And gives us time to kind of off ramp to the end of the year for whatever decisions we need. And
we're all getting so busy in November and December anyway, so it just makes a lot of sense. So this is kind of like your fourth quarter, kind of like, coach rah-rah meeting, charting out some plays here, but you also do something a little different, right, in the spring.
Yeah, so this is different than what we'll do in the spring. So I meet with clients twice a year, and in the spring, we'll call it during tax season, if you will. And since I do prepare taxes for a lot of people, not everybody, but a lot of people, it's kind of a built-in thing where we can talk about taxes, which is always the elephant in the room. And then I also go over what I call your one-page financial plan. Again, visuals, there's a theme here, but I give a visual that to you in March or April that kind of shows you, again, how your account's doing, kind of what our goals are. Again, a little snapshot of your net worth. And then we'll have our current to-do list and then our future to-do list, all on one page, a way to review this. And that's a little bit more, again, it's high level, but we're really kind of saying, this is what you got to get done during this upcoming year. This is what we need you to do. So it's kind of a different theme, but an important theme. And this is kind of how we continue through our financial planning process. And then outside of these two meetings, we'll have a theme that we'll go through, whether we're looking at property and casualty insurance, whether we're looking at making sure your insurance is up to date, whether your beneficiaries are correct, so on and so forth. We'll look at budgeting, boring stuff, but we'll have other themes as we go on throughout the year to make sure that, other financial planning topics are covered. So we just kind of have a cycle that we go through. But the main thing is we do meet in March and April, and then we also meet in October. So we have two big meetings where we have important stuff that we have, intentionally and deliberately, we kind of go through all this. And my clients are kind of in that rhythm. They kind of know what's going on, and they kind of know what to ask for, and they know what they're looking at in these reports as well. So it's a good rhythm, and it allows us to, again, provide, I think, a high level of service to all our clients.
Nice. So it's a good little cha-cha you got going on. Little salsa action. Yeah. And of course, every client situation is going to be different, I'm sure. And so therefore you have some different things that can happen. But I mean, it's the other reason why we do like educational pieces like the videos and the shorts and the podcast, because that's other ways to get kind of content or just kind of say, okay, well, what's going on with this? Like we've talked about tariffs and we've talked about, the IRMA surcharges and so on and so forth. So all of these pieces kind of wrap into the educational piece, the coaching piece, right, of what Coach does. So any final thoughts on this, Coach, before we wrap up?
No, you just nailed it, because there's always stuff going on, and that's why we also try and get stuff out to people a few times a month, whether it's these podcasts. Sometimes I just send you guys direct mail and kind of go over one beautiful bill act, whatever it may be. There's always stuff to go over, how to Social Security strategies. There's so much stuff to go over. But again, we meet for these two big times, and then we can communicate throughout the year. And so it's an ongoing thing with the financial planning process. I love it. I have a lot of fun doing it. I kind of nerd out on all this stuff, to be honest with you. And some of this is hard work that I do by hand, but again, I like it because I'm weird.
There you go.
So.
Well, if you're not getting that service or you want to get that service, if you need some help, then reach out to John. We'll have links in the show descriptions as always, so you can just click on book a chat with John.net, which is a great way to just get some time onto his calendar. You can go check out the main website at mearsmoney.com. You can pick up a copy of his books as well. We'll have that play here for you in just a second, but we'll have all those links in the show descriptions below. So don't forget to subscribe to us on Apple or Spotify, and of course here on the YouTubes, so that you can catch new episodes when they come out. Hit that notification bell and that thumbs up button. Thanks for hanging out with us here on Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears.
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by RescueMyRetirement.net. That's RescueMyRetirement.net. Fill in the basic info and he'll ship those out to you immediately. That's RescueMyRetirement.net for a copy of Diffuse and Tax-Free Retirement in California.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.